Hey, Kim, it's great to see you. Wanted to pick up our conversation from last time. I know we touched on a few things. We had just had a conversation briefly about peak life versus a flex life. And you had talked about the reasons why you may consider each, and in particular, why are we doing peak life?
Yeah, it becomes a budgetary consideration for each individual participant. The peak life product promises a retroactive guarantee return on the product of 1% as compared with that of Flex Life, all right, which has a 2% retroactive guaranteed credit. The Flex Life product translates into the additional benefit of a consumer or a participant in the program in the form of much smaller, or not, I shouldn't say much smaller, but smaller interest payment obligations so that we eliminate the collateral. The model is based upon that 2% guarantee retroactively, okay? So it has a smaller out-of-pocket interest payment because our guaranteed credit is greater.
Okay.
All right. The trade-off for that is because that 2% guarantee requires more cost, for the carrier to budget for it. The trade-off is a smaller amount of tax-free income,
Okay.
and it's not significant, but it is smaller nonetheless. Okay. So National Life Group recognized that, and they came out and created a product called Peak Life, which, first and foremost, delivered more value to the consumer and the participant in the Insured Retirement Advantage platform in the form of higher tax-free income. And they did that in two ways. One, they reduced the compensation to you as the advisor.
Which is fair.
That's right. And number two, they reduced the retroactive guarantee in the product to 1% as opposed to Flex Life having 2%. Now, you do get considerably more tax-free income out of the Peak Life product because the COIs are smaller and their budgeting and reserving requirement are smaller for the 1% guarantee as opposed to, again, the 2% in Flex Life. But it still comes back full circle to being a primary budgetary consideration for the individual participant or consumer. Okay.
And I also, as we're thinking this through, ethically, it seems like the Peak Life would probably be the best thing to do for the client.
Yeah. Peak Life also has one other additional consideration. It has a minimum face amount of $1 million.
Okay.
Whereas Flex Life does not.
Right.
So there may be circumstances where, we might not be able to get to $1 million based on health considerations, ages of individuals, whatever the case may be, or just individual consideration. But Flex Life does have the convenience of having a smaller face amount requirement where Peak Life is a minimum of $1 million.
And on the insured retirement platform, we still want to stick with that ideal barrier of $1 million up to $4 million worth of coverage, right?
Yeah.
So we wouldn't necessarily be able to finance a Flex Life if it was less, or not?
It's a case by case consideration for us.
Okay.
We're not going to go down to 100,000, no.
Right.
But if it was close enough in an individual circumstance to where we needed to go below the $1 million face amount because an individual participant, or an individual consumer wanted to participate in the platform, but $1 million was a little bit too high. But yet they still met our minimum income requirement of $150,000 a year. But the income, trade-off wasn't as great to them, and the out-of-pocket interest payment requirement was smaller on Flex Life as opposed to Peak Life. And for whatever reason, they didn't care about the death benefit. It was all about the acquisition and putting another leg on the retirement stool for tax-free income, via the life insurance product itself. So if we needed to reduce the death benefit down to $900 or $800, we would do that on a case-by-case exception basis, assuming that everything else is in line. It passes loan committee review, their income's in place, we can justify entering into the transaction with them.
Yeah, and I like that checks and balance because you're going to make sure it's right for the client.
Right.
And that's the bottom line.
Yeah, if premium finance is not suitable for everybody.
Right.
It's not free insurance. There are obligations and responsibilities on behalf of every participant or borrower, if you will, in the transaction. It is not free insurance.
Sure.
There are obligations.
Well, a couple things that are interesting is since you and I did our first round of questions 3 or 4 weeks ago, things seemed a lot different. The market was higher, interest rates were lower. Talk about this craziness and potentially what is the risk involved in this strategy because of what just recently has happened.
Yeah, it's been an interesting dynamic. Historically, interest rates have had a spike, that again historically you haven't seen over the last 24 months, or as big a hike in 24 months as what we've experienced, coupled with the awful drop in the stock market in the last 30 days. You can put aside political considerations or anything of that nature. I mean, the reality is we have a rising interest rate environment, although it's leveled off somewhat, coupled with a stock market that is, going through wild gyrations. You can set all that aside, because I think the benefit and the advantage we built into the Insured Retirement Advantage platform was that everything was built and predicated upon a worst case performance scenario for the product and the individual consumer participating into it. Our primary goal, first and foremost, is not only to deliver enhanced buying power and increase benefits in the future, but more importantly, it's protecting that end consumer to make sure that they are suitable to be in the transaction, and that in the event things don't perform as what we all hope they will, we've still covered them from the standpoint of using the worst case mathematical performance scenario in the design of the platform.
So the risk that we touched upon last time is the fact that you potentially could get in a rising interest rate environment, which affects your loan payments.
Yeah.
And then you could get in a period where you get the perfect storm, that you're getting a market that's not doing anything. So you're getting a zero return on your policy, and you're getting an increased, loan amount that you potentially have to pay. Is it best then to try to cap that loan, or just ride it out? I know we talked about we need to dispel the myth that everybody thinks if interest rates have gone up 1%, my loan's automatically gone up 1%. That's not the case, but what's the best solution?
Yeah, it's actually a very good question. And again, the thing that I'm most proud of is the fact that we guarantee our consumers or our participants in the platform options.
Okay.
A lot of institutions, financial institutions, lenders, banks, etc. And I say that, not for any other reason other than there are different types of lending institutions out there. But
we get it.
We built everything around making sure that the consumer has options.
Okay.
Most banks and lenders in this space do not allow a client any other options to adjust for unforeseen situations, much like what we've encountered in the last 24 months. We've got obviously a considerable amount of transactions on the books, being the largest funder in the space for the last 4 years. At the end of the day, we do allow a client to make a free material change at any time during the first 5 years. Those changes could be inclusive of, maybe reducing or skipping interest payments without us calling the loan. That may necessitate, a borrower posting collateral at some point in time, albeit a very small amount. But at the same time, they do have the option to adjust their payment structure. Okay. And secondarily, if not more importantly, they also have the ability to manage what is easily the single greatest element of risk in a premium finance transaction, and that's the management of the loan balance. To that extent, we offer the client the opportunity to utilize caps or collars, if you will. A cap being, exactly that. The consumer can tell us what he or she wants to cap their loan interest rate out at for a period of long as 5 years. Typically 2 years right now is the sweet spot in terms of cost, and I would argue historical efficiency. If the consumer wants to cap their loan interest rate at 6%, and this is in these days rates and environment, if they wanted to cap their interest rate at 6%, they can do that for, again, going out as long as a period of 5 years. Or, and if interest rates exceed that, they'll be capped at 6. However, if they, guess wrong and they come back down, a cap offers the consumer the benefit of their rates either staying where it's at or being reduced, depending on the lending institution, okay? A collar is exactly that. It's going to lock in their loan interest rate for a specific period of time at a specific rate. Okay. So again, to use my previous example, if the client wanted to utilize a collar, if you will, both of those two options are facilitated via the purchase of a swap, and I want to make sure that's not free. There is an additional cost involved in it.
Which is going to affect the performance and everything. Okay.
That's correct. But if an individual becomes concerned about the interest rate in his or her transaction, the point being, again, they have options. And that's not something that we just say. It's actually on our website.
Okay.
And it's in our premium finance app under our one free material change guarantee. The caller, again, can lock in a rate at, say, 6%.
Okay.
For a period going out as long as 5 years. So if they wanted to lock in a 6% rate for 5 years, they could do that. The only challenge that I would offer in the implementation of a collar would be simply that if they guess wrong and interest rates did go back down, and by the way, let's keep our fingers crossed.
Yeah, we've seen that just happen.
They're locked in. They're locked in on whatever that collared rate was that they chose.
Could you make the argument that really that kind of minutia makes sense with larger loan values, because the cost with your lower loan values is going to be much more significant as opposed to a $600,000, $700,000, $800,000 loan? Or am I missing the boat?
No, I think it's an individual consideration for each individual participant. Okay. If a person, we're engaged in a number of large nine-figure transactions for some ultra-wealthy people. Okay. But their concerns and their considerations are no different from John and Mary Smith down the street that are, a successful couple making more than $150,000.
Sure.
Whatever concern that they have, it's of equal importance to them as it is to these individuals over here, just on a different scale. So again, I'll come back and simply say that these individuals over here deserve the same consideration and necessitate and need the same type of options to deal with their transaction, just as the uber wealthy do. And that's the reason we also built out the platform. The platform delivers additional value in the form of enhanced and increased buying power in terms of the death benefit, as well as the enhanced and increased deliverance of tax-free income in the future. And as you also mentioned earlier, the living benefits provisions.
Right.
Those are value.
The small case platform, the other value is that collateralization that you talked about.
Yeah, we built the entire model around potentially the elimination of any need for additional collateral. Can I unequivocally guarantee it? The answer is no. All right. In the event a carrier was to raise their cost of insurance charges to the guaranteed maximum, and that's clearly an historical anomaly relative to what's happened the last 200 years in the industry. But in the interest of full disclosure, they could do that. I've only seen that happen. I've been in January, it'll be 40 years in the business for me. Forget my bushy head of hair. But I have seen 3 carriers do that in my 4-decade-long career. So is it possible? Yes. Is it likely? No. And history certainly is on our side in that regard. But
are you concerned about maybe some of the carriers lowering their caps?
Sure.
What do you think that does? Does it affect the strategy that much?
Well, again, in the Insured Retirement Advantage model, remember, we built the entire chassis around really the worst case performance scenario. Guaranteed. That was the key to the whole thing. The second biggest advantage we have in the platform is we couple that, thanks to our capital source in the transaction, with that of an amortized loan chassis. Banks typically in this space do not like to offer amortization of their loans because that's where they make their money, in fairness to them, and every institution deserves to make money. In this particular case, because our primary goal was to deliver additional value to Middle America, who are the primary participants and candidates for this platform, are the president and CEO of Global One, who is our partner in the platform, agreed to allow us to couple, our loan, the amortized loan chassis, with this entire transaction. And that's really what makes it sing. So as long as we're able to manage the loan interest rate in the transaction, which again I spoke to earlier relative to the material change provisions, we're good. Market performance is going to always be up and down. It's going to be wild, albeit maybe not to the extent it's been the last 30 days. Yeah. But it's always going to be like this. You and I were discussing my personal insurance earlier. Yeah. My renewal date was November 1st. I got lucky and capped out for, the 4th consecutive year in it. The people that, we worked on a renewal basis last week, they didn't benefit from the same type of, double-digit earning. I mean, a lot of them are getting, significantly less interest crediting, than what they had hoped for, but they are still getting credited. And they do have the 1% guarantee to fall back on. And again, that's what the basis of the math was built upon.
Right.
And
I think, and we maybe should explain caps just for a second so people understand what a cap rate is. You want to run it that, or you want me to?
Yeah, it's you can do it as well. I mean, a cap, as stipulated in the illustration, is determined by the carrier. And it's really a function of how much money they have to set aside out of each individual premium to fulfill their reserving for the guarantee that they're promising in the contract itself. Any additional money left over is used to put into an option budget, and how much money, coupled with the cost of those options, is going to determine how each individual carrier arrives at their caps. The easiest way to describe the actual functionality or performance of the cap is simply this. And I don't know how appropriate it would be, to use a gambling analogy, if you will, but if you like to play blackjack,
right,
and you walked into a casino, and at one table here, if you put down your wager, and let's say it's $5, if you put down your $5 and you win, then you win $5 more. All right. If the dealer beats you, you lose your $5 and you're back to zero. Right. Over here, though, you have the index table. And if you put down your $5 over here and you win, you're going to win a portion of whatever your amount that you could win is capped at, let's say $2.50. All right. You're going to win $2.50. However, in the event the dealer beats you, you bust. All right, and you bet $5, you still have your $5. You just don't lose. So you're always going to share in a portion of the winnings, or in this case, as it relates to the IUL, a portion of the upside growth in order to totally eliminate the downside risk. So I'll ask you this. Which table would you play at? The one where you do get all of the reward if you guess right and play well, or the one where you never lose?
Some people would say it probably should have a little bit of both.
Well, I guarantee you the line over here for the index table is never ending, because
2008 is still embroiled people's minds, especially with these last couple of weeks.
You put down your $5. If your cap is $250, well, you still got your $5 plus $250. If you lose the next 10, you still got your $750.
Right.
That line is never ending.
So the example would be if they had a cap rate of 10%, you would participate up to 10% of the growth of that index.
Right.
And if the index were to go down 10%, zero is your hero.
That's right.
So the worst
You've
case
got a
scenario,
guaranteed floor.
And the other thing I think is nice about cap rates and explaining is it locks every year. You don't give back what you made or lost, and I think that's important. It's an annual reset.
Yeah, that's an excellent point.
It's more like the market does this. I always tell people it's a staircase. In what we're talking about. A little bit easier to manage sometimes.
Well, it takes the guessing out of it. Yeah. I know there are advisors out there that are big proponents of a multi-year allocation choice. We're just not one of them.
Right. Incidentally, the research is showing 1 year still is traditionally the best because of that lock.
That's exactly right. It's what you just touched upon. The reset capability and locking in all prior gains, or locking in gains and locking out losses.
Right.
That's the key, and that's one of the benefits of indexed universal life as compared with that of variable life, whether it's variable universal life or variable whole life. If an individual wants to participate in 100% of the gains related to market performance and their growth, by all means, they should buy it. Just understand that, with all the gain of the reward comes all of the risk. The benefit and the beauty of indexed UL is, again, you're going to share in a great portion of the upside growth potential and those gains in return for totally eliminating the downside risk.
And people need to understand in those variable life products or things of that nature, there's going to be extra layers of cost that are going to make those policies inherently more expensive.
Yeah.
So you're going to have to see some extra bump to make them work.
Yeah, it's a suitability issue, and up to every individual's risk tolerance.
Right.
We don't offer and we don't utilize any variable life products in the Insured Retirement Advantage platform because it's not designed for that particular market.
It's a steady eddy, sure.
That's right. Yeah.
Interestingly enough, I've gotten this question twice in the last couple of days. Why in the world would a bank participate in this?
It's a great question. I get that, probably once a month. In the early days, 20 years ago, I got it all the time. But it's a perfect hedge. Most banks turn around and actually loan money out to small business owners that are borrowing money for whatever the reason be. Maybe they need to purchase new equipment, or they also loan money out to people wanting to buy investment properties, whatever the case may be. Those loans come with risk, and generally are unsecured. Not always, but
Sure,
most of the time.
sure.
In this particular transaction, the bank is fully collateralized and has zero risk. So it becomes the perfect hedge for that particular lender to count on and know it's there, that has no risk. The return is smaller, but it's the perfect hedge to offset those riskier loans that the bank admittedly makes more money on. All right, but that's
more
the
risk.
purpose. That's exactly right.
There you go.
This offsets the riskier propositions, and at least the bank knows how much they can afford to lend out over here because they have a hedge over here. So it simply becomes
It's almost that analogy you just drew up with the cap rate.
That's right.
We'll get some of this, just not
That's
all
exactly
of this.
right. So they can determine how much they want to
Ironically.
lend out,
Sure.
because they have it hedged over here.
Right. Oh, that's interesting. I know last time when we kind of wrapped up, one of the things that you really wanted to spend a little bit more time on and really wanted to come back and talk about was the fact that many different type of professions and business owners and different people can use this product. I know we focused on just one small group. Why don't you talk about the many different opportunities that are out there?
Yeah, specifically, the platform is really designed for not only middle America, but small business owners. And you and I are small business owners.
Mm-hmm.
As a matter of fact, 3 out of every 4 people in this country work for a small business. So at the end of the day, and that's also inclusive of a lot of physicians and a lot of attorneys,
Mm-hmm.
right? And subject to each individual small business owner or highly compensated individual's legal counsel, as a part of our process. If we're loaning money directly to a corporation, all right, and they've given us 2 years of tax returns, we've seen revenue, they're a suitable candidate to be in the transaction, they have sufficient revenue, which typically we look to see at least $750,000 a year in revenue, and the business owner has $150,000 a year in income. As long as they're a suitable candidate, then that's what the platform was built out to deliver the value to. But at the same time, that could be Bob's Muffler Shop down the street.
Sure.
Or it could be, Dr. Jones' medical practice, or it could be Mr. Smith's legal practice. When we actually loan to that corporation, the day after we fund the policy on behalf of the insured, all right, we go back, and I say we, I want to, in the interest of full disclosure here, make sure that I mention it's Global One, all right, and as a wholly owned subsidiary of Synovus Bank, they're going to go back and file what's called a UCC1 filing against that company's assets to secure their loan. In addition to that of the cash value, because it is a commercial loan. There are those legal professionals that would argue that it could provide some additional corporate asset protection in the form of that UCC1 filing, and specifically Synovus Bank and Global One being in a first position against the company's assets. I'm not going to take a position on that, but certainly there are legal professionals out there that would suggest that that's an excellent form.
Yeah, they're in first position.
Corporate
is what you're
asset
trying to
protection.
say.
That's
Everybody else
correct.
comes to the party later.
It's an ancillary benefit, I'll argue, because the business owner does have the option. If, say, for example, you wanted to buy another agency down the street or another advisory firm, and you went over here to Bank of so-and-so, and they agreed to loan you the money, provided you would allow that bank to place a UCC1 filing against your corporation. So you go ahead and do that. But at the end of the day, if you come back and, another advisor says, well, Pat, you can do that, but Global One's got to have a first lien against your company's assets. Actually, we'll move, and again, I say we, it's Global One. Global One will move that lien back to a second or a third
To allow that to
or a
happen.
fourth, or if you request that they remove the UCC1 filing against your company's assets after they funded the contract, as long as Synovus and Global One are fully collateralized and they're securing the transaction, they will do that for you. So I would submit that it's an ancillary benefit
Sure.
that comes as, another benefit from the commercial lending chassis.
Someone
That's
asked,
a big deal for a lot of people.
and unfortunately, one of the big risks I always tell people is we're a litigious society.
Yep.
It's lawyers, love to sue, and people get sideways about the smallest things, and it blows up, and before you know it, it's a mess.
It's up to each individual business owner's legal counsel. And I'm not an attorney, so I don't give legal advice. I'm not a CPA, and I don't give tax advice.
Right.
And neither do you.
Right.
But at the same time, there are a significant number of those two professions and professionals within those professions that would suggest that this is at least a form of corporate asset protection. And that's a big deal for a small business owner,
Sure.
which generally, the value of their practice, I don't care if it's a doctor or a lawyer, the bulk of their net worth lies in the value of that business.
Right.
Why don't you protect it?
I got asked this question. What happens if, I'm in this transaction, maybe 3-4 years, and we decide to sell our company? What happens? And then the flip side I got was 3 or 4 years. I just did a business recently where there was 3 people involved. One of the people gets really sick or hurt and can't, work or, no longer participate in the company. They kind of asked me some of those scenarios.
Well, if you were selling your business, the borrower has options. Okay, one, they can pay off the loan.
Right.
All right, that's certainly an option. The entity purchasing, that business that's being sold, could also agree to pay off a loan so that the borrower then and the participant in the platform would be able to take their transaction.
You can make that fundamental change you talked about.
We can also change borrowers as long as there's a nexus in the relationship, and clearly one business buying another would constitute a nexus between the two entities. But if your question is really built around the query of could they change borrowers in the transaction for a variety of reasons, the answer is yes, provided too that borrower also qualifies financially and is a suitable candidate to be in the transaction.
I think their question was if we made this 5 or 10 year commitment and we sell our company 4 years from now, we haven't fulfilled necessarily that. What I told them is in theory, then you would presumably be getting some type of large cash infusion. So you could pay off the loan, you can continue to, just make it yourself. You're going to have a variety of different options. The world's not going to come to an end.
Right, and depending on the type of transaction that's entered into between the corporation acting as the borrower and the individual receiving the benefit, if a split dollar agreement was implemented in the transaction, you can certainly make the argument that it would be a cash on cash swap, if you will. The insured potentially could be subject to, imputed interest income benefit. Well, let me restate that. Would be subject to imputed interest income benefits, taxed at some percentage, whatever their tax bracket is at that time. But essentially, you're taking over all of the cash value in the policy unencumbered, which, again, under current tax law today, allows one to access it on a tax-free basis, whether it's today or at some point in the future.
Right.
But it's a fair question, but the good thing from our side of it is that if an individual is looking to keep the transaction in force, they did buy it for a reason. If their circumstances change in such a way that it requires, a different borrower coming on for them, the answer is at least they have the option to do so. It's not that, they're selling out, so therefore we have to unwind the transaction, surrender the policy, everybody goes on their own way.
Right.
That's not the case. Again, just as we talked about with the one free material change guarantee and borrowers having the ability to manage their loan interest in the transaction, the same thing's applicable here relative to borrowers. They have options.
Right. The flexibility and the options, I think, are very important
Right.
for people to understand. And also, they're not going to have a situation where it blows up and they don't walk away with,
Right.
something. I think people fear that, oh, I'm not going to get anything. And that's not true at all.
Right.
It may be a reduced benefit. It may look differently, but there's still going to be inherent value
Right.
there. On the premium finance, it can be a very confusing conversation in some respects. So I like the fact that you've talked about more the leverage, moving away from getting into the minutia of the premium finance, and understand all you're doing is you're leveraging, amplifying the amount of benefits that you can get while not having to pay for that out of pocket dollar for dollar.
Right. Let's assume. Let's take your hypothesis there and run
Right.
with it for a second. If an individual has committed a premium amount to put back for savings, then their whole motivation for buying an indexed universal life product from you was either the living benefits or the death benefit or the potential for tax-free distributions in the future under current tax law, all right? Or all of the above. All right. If their commitment to you for that particular transaction was, say, $25,000, all right. Well, if it was $25,000, you would ask them to consider doing just one thing. Take and consider recharacterizing that $25,000 out-of-pocket, after-tax premium commitment to become that of an interest payment, so that in return you could fund their policy with not $25,000 but $50,000
Big deal.
for at least 10 years. And you've heard me make this analogy in this comment. You give me 5, I'll give you 10 at double the amount. Therein lies the ability and the benefit of leverage, if you will. It enhances and increases one's buying power for whatever the reason be. Again, maybe it's the living benefits, maybe it's the death benefit, maybe it's the potential for tax-free income in the future, or all of the above.
Sure.
If they'll simply consider your recommendation that they recharacterize whatever their out-of-pocket commitment was to you for the particular policy, you can fund it with double the amount of capital. And that translates into the additional benefit of death benefits, living benefits, and also potential tax-free income.
Yeah, that's huge.
And you do have flexibility. I want to keep coming back and harping on that because, there are other programs out there that, if you don't make 100% of your required contribution in the first 5 years, they'll surrender your policy,
Sure.
and that's just your tough luck.
Right.
You lose everything you put into it, and I just don't consider that an honorable situation. As a matter of fact, I'll just leave my comment at that.
Right.
But in our particular transaction, that's why we have an advantage over everybody else. We give the consumer and the individual participant flexibility to deal with those unforeseen events because life happens.
Sure.
Stuff happens. And if you get into the transaction in the 3rd or the 4th year, or God forbid, the 5th year, and something unforeseen and potentially devastating happens, you have options,
Right.
whether it be to reduce or maybe skip the premium payment or the interest payment in our transaction altogether. Whereas, if you're just using that same out-of-pocket commitment to fund a life insurance policy, this life insurance policy that they agreed to fund $25,000 a year with you, it can never catch up with the one that we're funding with $50,000.
That's right.
But more importantly, if something happens, just like you do in a traditional life insurance policy, universal life, you have the same options over here relative to your interest payment. You can reduce it. You potentially could even skip it. And if you needed to post collateral, say you needed to skip the payment for more than 1 year, they have the option to do so. Maybe they become revenue light. Their business is still doing okay, but something unforeseen happened, maybe to their family member or to themselves individually or something related to the business. They just had a need to alter the transaction in some way, and in the Insured Retirement Advantage platform, that borrower and that participant has those options.
And last time I checked, we all running around looking for that deal, that discount or whatever, so now pay, why wouldn't you want to pay 50 cents on the dollar for something? It's a no-brainer to me.
You give me 5, I'll give you 10 at double the amount.
There you go. I mean, enough said.
And by the way, the longer you pay the interest payments,
more
the
attractive.
greater the potential benefit is in the future. Again,
Right.
whether it's the living benefits or it's the death benefit itself or the
magnifies.
tax-free income. I mean, ideally, we'd like to see you do 10 years. You know, we've got to have at least 5, but if you'll go 10 or even longer than that, you know, because you do have options.
Just amplifies.
Yeah, the greater the benefit and the greater the reward.
I'm sure someone's ever has asked you this. What if tax law changes? I know that a couple of times they've challenged the tax-free benefits of life insurance, and it didn't ultimately come to fruition. But
Yeah.
does that concern you?
Yeah, sure it does. I mean, at the end of the day, they've also attempted to tax the inside buildup of the cash value itself. You know, again, me not being an attorney, you know, I don't give legal advice, but all we can do is look back and see what's happened historically. And you're right. Certain members of Congress on a particular side of the aisle have raised that issue with the obvious intent to raise tax revenue.
Sure.
They have not been successful to this point. Do I think they'll be successful in the future? You know, Pat, I mean, you and I both been doing this a long time.
Right.
I guess we could offer speculation. I don't believe they will, but you just don't know.
Yeah.
But I can say this. If you were to ask me, do I believe the transactions that were on the books up till that point that legislation was passed, would it be grandfathered? I'd have to say yes.
Yes.
You know, historically, that would certainly support a yes answer, but you and I can't guarantee anything because, after all, it would involve Congress.
Okay. Yeah.
And there is no guarantee where they're involved.
Someone always said that if the IRS was a baseball player, they'd be in the Hall of Fame because they've gone like 15 for 17, 15 changes in 17 years or some craziness.
Yeah,
but
I mean, you know,
taxes are just a fact of life.
That's right. You look at the estate tax laws in this country. I mean, they've changed 39 times. You know, and again, depending on which side of the aisle you're on, I'm not going to state which side I'm on, but at the end of the day, they've both got their preferences, you know, and they've actually even done away with the estate tax laws 4 times. You know, I don't know how much of a good luck benefit it is to have passed away during the times recently as 2010 to where there was no estate tax, you know, because it does involve somebody passing away. But from a financial perspective, yeah, you could logically argue there was a benefit to that, but then once the political party in power changed, you know, they brought it right back again. So I would submit that it's always going to be, you know, a fluid situation, if you will. But as it stands today, based on history, you know, do I think that the whole transaction would be grandfathered? Yes, I do. Could that change in the future? Sure. Your guess is as good as mine, but there's historical precedent.
Well, the last time
on
I
our
checked,
side.
the life insurance industry is kind of big too. So
Yeah.
I have a feeling their lobbyists would
Yeah.
be out in force. So.